on that note, I can invite Andrew Cave, Head of Governance and Sustainability at Baillie Gifford, to join me. Thank you very much, Andrew. And you'll be pleased to know that I'm doing a little plug for
Thanks.
your... This is a really good pamphlet, actually, that Andrew and I are actually former alumni. We studied together at SOAS. I won't say when, because it's quite a while ago now.
It wasn't last year.
No, it wasn't last year. But this is a really good pamphlet looking at the history of ethics in investment. And I think, I spoke about how there is growing momentum around investing more ethically and sustainability, but you also talk in this booklet about how the push for more responsible business and ethics in finance actually has a long history. And there's some really good examples in there. So I wonder if you could perhaps speak to that history and also perhaps say in what ways that you think what we're seeing today in terms of ethical investment differs from perhaps momentum that we've seen in the past.
Sure, and thank you very much for introducing the booklet as well. So, I mean, the background of this document was I was asked by clients quite often, what was the backstory to kind of ESG, responsible investment, sustainable investing, and it become clear that people had picked up a lot of the recent language of ESG integration, or the Sustainable Development Goals seem to have got traction in a way that no previous initiative has before. And what became apparent was sometimes people didn't realise that there was something before the Sustainable Development Goals. So I thought, wow, okay, I really should signpost that there was the Millennium Development Goals, and they built on kind of earlier initiatives on sort of different specific issues. And so I just thought it would be helpful to put together this sort of, I'd say, backstory of the foundational layers of responsible investing. Because what we're seeing today, this sort of inflection point of meteoric rise of interest, builds on all those foundations, and that was sort of my insight, was you can't have a go at doing responsible investment in a kind of international or global sense unless you take your starting point as the emergence of international norms. So that's where it links into the development story and the Universal Declaration of Human Rights. Because prior to that, there wasn't really a sort of universally agreed view of what fair or behaviour was in different markets and how you should treat people. It was all very country by country, and so we owe a lot to that early foundational work from really 1945 through to kind of the 1970s, when a lot of the kind of international principles come into being, and then the first environmental protocols and first roundtable initiatives that sort of set that scaffolding. And it's really that's those kind of documents and policies and understandings they're the kind of day-to-day tools we use in responsible investing in different ways when we're trying to sort of figure out whether a company is doing enough on an issue or not. So I kind of felt the backstory was important. What's really clear too is that up until really the last year or two, ethical investment has been a niche sub-strand of asset management. So there was a number of very good boutiques, but big asset managers, if they had a product, it was tucked away in a corner, and it was somewhere that you might retire investors onto. It wasn't where you put your very best, brightest investment staff, and when you put lots of resources into it, it was something you offered for clients who wanted it. All that's changing very rapidly now. So you're getting an explosion of products out into the market. Now, I'm not saying that's necessarily good. I think there'll be a day of reckoning at some point in the next few years as the regulators get a better idea of greenwash and how to sort of challenge funds and what they're actually doing. But nevertheless, this is a really important moment. This is ethical investment is going from a niche sidearm to the mainstream, which is actually exactly where it needs to be, and rapidly so. If we can't really see that fulfilled in the next decade, then we've got sort of major problems.
Yeah. So you mentioned some of the international principles, and of course we've seen over the last decade the emergence of, for example, the UN's principles of responsible investment. Mm-hmm. are these helping investors and your company specifically in their investment decisions? What impact do you think these kinds of initiatives are having?
I think they're very helpful in terms of setting the broader context. So many clients have come to us to discuss responsible investment because of the UNPRI. So they've been asked by whoever, their members, or they've been at an industry conference with sort of, peers, and the PRIs come up and they're not signed up and they want to know why. And so it's a very good starting point, but it doesn't give you kind of the detailed roadmap of how to do responsible investment, because that's actually really, really hard. And I think it's not at all done yet in terms of how we do this. So the debate is still very much ongoing as to whether divestment is actually better than engagement. I don't think you can even answer that. I think they play different roles in the market. And if responsible investment is all about trying to create decent returns for the underlying asset owners, but also direct finance in a way which improves the world, those are two very valid channels. And I don't think there's been enough intellectual analysis of which of those two is most effective. And if I do have a worry, it's that it's very easy to just add more and more exclusions, because that's easy to explain. The marketeers like it, the legal teams like it, and asset managers. It's really clear. You just say we don't invest in the following 10 sectors. Now, my worry is that becomes 12 and then 15 and then 20 sectors in time, because actually there's probably nothing as helpful as a well-informed asset manager with a large holding engaging a company on an issue, particularly when they've invested in internal expertise to really push and challenge those companies. So there's a danger that the most progressive companies get pushed into divestment as the only sort of option. So I've had that recently with tech firms, people saying, why don't you just exclude all tech firms? I think, well, we can't. Tech is ubiquitous, and it's becoming more so. Google alone has 7 products with over 1 billion users. So this isn't like tobacco. We have to continue to engage and work with tech to figure through some of these big social and environmental issues.
So on sort of this whole debate around sort of defining responsible investment and the whole some of the concerns around sort of greenwashing, which we've seen a lot of. I mean, you mentioned exclusions and divestment perhaps from tobacco or fossil fuels or other types of investments. We're seeing now investors increasingly want to not just have ESG aligned investments, but move towards having a positive, a deliberate positive impact, sort of more the impact investing side. What do you see as the growth of that kind of market in the future? There's a lot of interest there, but also some of the lack of standardization around ESG alignment, the lack of consensus around how to perhaps measure impact, perhaps leading to not enough or perhaps concerns over the credibility of the market, perhaps.
It's a bit of a mess right now. We've got a long way to go. So if this was the sort of the evolution of the financial sector in ESG terms, we're kind of in the equivalent of the kind of earliest days of market rules forming and sort of norms. Think Lloyd's coffee shop, sort of 18th century, but the difficult bit is this industry has to grow up really quickly. The ESG world has to professionalize really rapidly, because there's 2 reasons. One, the world needs it, and 2, real money is moving into these asset classes. So we don't have time to kind of feel our way. We've got to try and rapidly figure out the rules, and that will need collaboration between firms, regulators, civil society, others, to try and get it fit for purpose. That's my worry. It's still a sort of fairly youthful field. There's not many people with more than sort of 10 years experience in it, and so it's a big responsibility to start making key decisions about moving money. So supposing we get it wrong and we divert capital away from a company which actually could be part of a long-term solution to a big societal issue, that's a huge responsibility. I mean, the easy ones are companies that clearly do harm, and you can argue about how hard should you be on those firms, but I'll give an example. One of our holdings we really like is a manufacturer of microscopic heart pumps, and it scores quite badly just now from some of the big ratings agencies because it's very focused on innovating to save lives with heart pumps. It doesn't do a lot of reporting. It's not a leader on sort of CDP disclosure, so it gets marked way down. But if you invest in an index which uses that scoring, you will not be investing in that company, and your capital will have been diverted from that company. So there's very real stakes here. So that's why I think we need to kind of rapidly push on. Just one point on the language. There's huge confusion between ESG and responsible investment. I try to put really clear water between them. And the way I see it is ESG integration is just that lives within the existing financial investment paradigm of understanding the full range of risks and opportunities which affect a company's outlook. So it's trying to weigh that in, and it's ESG integrations is all about understanding the climate risk of a company that you didn't think about climate risk before for, or the risk of data privacy regulation for a tech company. Of course you should be thinking about that. You don't need permission from the client. It's just good, common sense investing. Responsible investing, under all its guises of impact, sustainable, aims to go a bit further. And it's there's different degrees of how much further you go, but I sort of see the differences. ESG integration is predictive. You're trying to weigh in what might happen and invest against that. Responsible investment is directive. It wants a particular outcome, and it's trying to use the money to get towards that particular outcome.
And in terms of sort of the responsible investment, so the investment that seeks a positive social or environmental impact in addition to a financial return, we're seeing more interest in that market. Do you think there are still, do you see in your work concerns of some investors that there is a trade-off between social environmental impact and financial return, or what are you seeing?
So for our particular funds, we don't see that trade-off, but I think we're in a kind of the great position of we're a concentrated long-term stock picker. We try and put together a small number of companies in a portfolio and hold that for the long run. So we just have to go out and find 30 to 70 to 100 really great companies which have the ability to transform sectors and economies over the next decade. So we don't feel that constraint. We feel that there's easily enough great companies to do that and achieve very good financial returns, if not better. And this is the key question. If any of us today were asked to pick a portfolio of companies that you couldn't then trade for 10 years, common sense would tell you to sort of pick companies whose business model you think is sustainable, that has a decent chance of avoiding the worst of regulation, or actually even better, getting in front of a societal demand for cleaner energy or more targeted precision healthcare. So that's really what we do. So we have an easy starting point in a way. I think as you go further and further out and you invest in more larger and larger portfolios, that might become more of an issue.
So in terms of looking forward, we've talked about sort of the momentum in the investment market so far. Next year marks a new decade. The UN Secretary General has deemed it the decade of action or acceleration on climate and the UN Sustainable Development Goals. So from your perspective, how do you think we can perhaps accelerate responsible investment, ESG alignment, yes, but more the impactful kinds of investment? And can we expect any bold announcements, or what is Baillie Gifford in particular going to be doing over the coming period in this area to boost its work in this area?
Yeah, so I think that there's lots and lots of things we can do to grow responsible investment as an asset class, and I think it's important to say actually it's still tiny. So despite what I said about it moving from the niche, there's huge interest, but the amount of assets that have moved into clear responsible investment funds with higher bar mandates is quite limited. But the direction of travel is very positive, and we're certainly finding more and more mainstream clients like big corporate pension funds or institutional funds increasingly comfortable talking about responsible investing.
Good.
They were all fine with ESG integration because that sounded safe, but you're getting more saying no, actually we should invest responsibly. So that's really positive. We're certainly doing everything we can to grow the assets. We've had a strategic review recently where our partnership got together and talked about the sort of 5-year outlook for this field, and we see huge growth in these assets, and we want to absolutely offer the very best products out into the market. So we'll do everything we can. I think the bigger debate has to be about the tough trade-offs and accepting that business as usual. Just we can't have another decade where there's lots of noise but actually little changes. We've got to see some really sort of big systemic investments, and I think asset management and investment generally can play a part in that, but it's part of a bigger political discussion, and it's a politically led discussion. Yeah. I think we don't have time to invest our way out of climate change. It needs more. I think the market can help, but only to a point.
So what do you in terms of your work and growing the responsible investment market, where do you see the low-hanging fruits perhaps? Where might the bigger challenges lie?
Yeah, well, I think it's the low-hanging fruit is better data, better disclosure. So we're in this kind of we're going to this kind of mini enlightenment here, where we're suddenly getting much better data on all sorts of things. Now, some of you have heard this from me before about mapping like soya in the animal food chain. We didn't know that stuff a few years ago. Now we know that the soya going into feedstocks in Europe and North America is one of the biggest drivers of deforestation in the Amazon, and we can start to see the data down the value chain. So we're looking at everything with fresh eyes, and this is great because it gives all of us much better data to be responsible investors, but it also adds huge new complexity because we're suddenly more aware. Things used to be quite simple, if you were worried about artisanal cobalt mining, you would just say we should just not do that. But then of course we know cobalt's one of the key materials for all sorts of useful industries like the electrification of cars and EVs. So you get into these sort of difficult predicaments, and the data just shows that complexity. But I think we just need to kind of keep working through that. But to give it a practical example, the E is, I wouldn't say easy. We need to make huge changes to address environmental issues, but most people agree on what needs to be done. I think the much trickier part is the S in ESG, sort of social, where there's very little agreement. If we were around this table and asked everybody, as an ethical investor, what social issues do you think are most important, you'd probably get 20, 30 different iterations of the answer, and you might get violent disagreement on some of the issues. So we're getting more and more of that. We're getting more clients asking about the S issues. So things like gaming and gaming addiction, and minors. What do we do with that? Is Facebook's core business model beyond the pale in terms of what they do, and how is social media changing society for better or for worse? Even privacy. Privacy is really over as a construct. We as we go to 5G and connected devices, we will all be tracked to some form if we take part in the modern world. Yeah. So we actually have to reframe our idea of what privacy is. It's about protections within that system, which give us comfort that as an individual, bad things won't happen. So, but trying to answer where we should kind of bottom out in privacy, that's really hard. Surveillance. So we've had clients talking to us about what kinds of surveillance are good in society. So almost everybody is comfortable with CCTV in the city centre, with a policeman at a desk looking at 4 screens. But as soon as you use AI to help that policeman, people get less comfortable because they worry about profiling and false matches. And then if you move to mobile camera installations, like drone mounted, people get more uncomfortable again for some reason. There's that seen as different, And so you get this kind of spectrum of uncomfortability, which I've literally done this in groups where every single person in the room is at a slightly different point. So S is really tricky. But I think the good news is the environmental stuff is starting to get some order to it. We're starting to get the right providers of data, and they're starting to get the right structures. So we're now getting clients coming to us saying, this is the outcome we'd like to get to by 2030 or 2040. Can you help us get there? So I think that's a sort of positive message that this, the infrastructure is beginning to be there to direct money in a sort of climate-aware way.
Well, thank you, Andrew. Some really thought-provoking material there for us all to chew on. Perhaps what I could do now is have a quick go around and see if there are any really burning and really tough questions, especially on some of the issues you raised around the social side. And then, but there will be time after Tom to have a longer Q&A session. But if there's anything really burning you want to come back to Andrew on, then now's the opportunity to do so. Yes, sir.
My name's Nick Blythe, and I work for Green Angel Syndicate, which specialises in investments in the fight against climate change and global warming at an angel level. So it's all very, very early stage, radical innovation. What worries me about the investment sector, the finance sector generally, in confronting climate change and global warming, and in the application of what they call ESG and what used to be called corporate social responsibility, and that terrible tendency to greenwash, is the gap between rhetoric and reality, which Andrew, I think you are, in a lot of the things you've said, you are working with in a way that is completely enlightened, and I would applaud. But when you start with an investment pot of billions plus, the issue is how can you invest that in things that really are good for society? Let's dispose with the words ethical, let's dispose with ESG, let's use simple concepts, things that are good for society in confronting climate change. And the point of that question is we still live, however we choose to hide from it, in a hydrocarbon economy. We still live in an economy which depends upon hydrocarbons. And that's not about the oil and gas companies and transport and the use of fuels. Look at all of the things in this room, the chairs you're sitting in, the table we're sitting at. Now, I bet whoever produced this table has got what they call a sustainable forestry policy. And I bet you the wood and the way they handle the wood is all, let us call it virtuous, aside from the fact that they're cutting it down in the first place. But the actual act of producing what they produce will have used energy, which was hydrocarbon derived. The actual act of then packaging it up and distributing it and bringing it to this lovely office environment here is all based on the hydrocarbon economy. So an investment in this company that produced this would, in theory, conform to ESG if the company is, as I guess it probably is, something that subscribes to all this. But that's the gap between rhetoric and reality. The reality is that this company is still supported by the hydrocarbon economy. How do you get over that in a way that recognises the reality that the bulk of the companies you're going to invest in under the banner of ESG actually aren't at all?
Yeah, I think that's a totally fair question. And I should say, by the way, a lot of the long-term solutions won't come out of investors like us. It will be out of, smaller angel investors and some early seed investors funding the very most innovative companies. We come in when they're much larger, and you could argue they've already arrived. So that there's a sort of conflict in our sort of positioning around that, which we're very aware of. Yeah, I know. I mean, I think sort of we probably need funds which go a bit further down the chain, and we do have a private desk now, which is moving us in that direction at least. But yeah, I mean, I think what the question you really raise is society hasn't yet geared up to the transition. So the investment world can't on its own. It can't get ahead of where society is, and we've seen this in politics. Politics has to be aligned with where the broad electorate are, and we've seen that in countless different elections in the last sort of 5 years. So what do you do? Well, I think asset management has to be honest with itself, and maybe be better at calling out some of those issues. I'm thinking of a recent discussion with Chevron actually, where I asked them how much of a barrel of oil, what percentage of a barrel of oil goes into actually transport for cars and light vehicles. 20%. So 80% of a barrel of Chevron's oil goes to other industrial uses. So I think there is a danger we're all kind of obsessing in just the bit which we're most familiar with, and it may be eminently fixable. So in industrial hydrocarbons is a much bigger issue. So listen, there's no easy answer, but I think what we've seen, particularly in the last year, certainly the last, actually definitely the last year and arguably the last 3 years, is this explosion of interest in discussing these issues and sort of proper intellectual engagement with this. And we've had that on our investment floor, so we now have investors fully engaged with these discussions, and and all the kind of trade-offs and catches. And I think we're seeing that from clients too. So you're beginning to get people to engage with, hang on, we need something much bigger here. We need a sort of a whole new blueprint for how the economy might work. And it raises some massive questions like, will that be a growth economy? And if you're a growth investor like us, what does that mean? So if the world needs to go X growth, how can you begin to fund 30-year, 40-year pensions in a world that's gone X growth? So there's really big systemic questions. But I'm an optimist. I'm certainly taking the long view. I'm massively heartened by how sophisticated the discussions become, and just data is really better data is now augmenting the job of responsible investment in ESG in a way that it wasn't the case before. So you're getting this really rich helicopter view of these issues, which just an example. So companies now don't get away with just reporting their Scope 1 and Scope 2 emissions, all the actions in the Scope 3, which is this other stuff. So you're getting Amazon now properly engaging with the carbon footprint of its delivery network and subcontractor delivery network, as well as its its own sort of site emissions. So that's the beginnings of that proper 360-degree assessment.
I think in relation to this point, it really strikes me that out of the 17 Sustainable Development Goals of the UN, the one you tend to hear quite little about is the one on responsible production and consumption, because we hear a lot about efforts to reduce poverty, or gender equality, or improve health and education, and some of those, and there's the climate change, obviously, but it seems to me that this one is really quite neglected, and in order to fulfill the requirements of that goal, there really need to be some fundamental transformations across energy systems, across transportation systems, across food production systems, across the fashion industry, all of these with major repercussions, real structural transformations of economies worldwide. That's political, of course, but yes, it has, how can governments responsibly manage that? What is the role of the financial system in supporting a just transition to a new economic model fundamentally? But it always strikes me that that's always a missing one in the discussion. Yes, please, very quickly, and then I'm going to move to Tom, if that's okay, and then there's more time certainly at the end for another round of discussion. Yes, please.
I think this follows on from the last one, just thinking about what you're talking about, and about how you're very involved in these issues and you might want to do things about it, but as an asset manager, you're ultimately an agent, and you're looking after other people's money. And how do you think about that boundary between what you can and can't do, what you might have a license to do and not have a license to do, and how you might work to potentially shift that boundary through education or nudging or things like that?
We think about it a lot. So we're very conscious. So it's a firm like ours is an illusion. It seems almighty. We're managing 200 billion of assets, but that's not our money. Like, it can all go very, very quickly if you lose sight of the fact that it's not your money. So these businesses, that they're only as good as their culture and maintaining that culture of, putting the client first and doing right by the client. So we're very conscious it's about helping our clients, get to where they want to get to. Now, hopefully, thankfully, they're all asking the right questions and sort of going down that curve. But really, I think the big fix in asset management is activating the real owners of capital, which is broadly the members of ordinary pension funds. So everyday working people who are saving for retirement, and we're talking to a couple of new startup suppliers doing some really interesting stuff in this place. Tomello is you might have heard of as a newish startup, and they're working on content for smartphones, which will allow you to, with a couple of very basic inputs, pull up your pension fund and its top 10 holdings, and then allow you to follow up with different actions, what you'd like your asset manager to do. So I think all that's really, really important to sort of connect people back to their capital, and then that gives us the mandate. If we could get even 10 billion or ideally 50 billion into responsible investment funds, they can really start to push companies in a certain direction. When it's 1 billion here, 1 billion there, it's just not enough to move the dials. So we actually need money to switch into responsible investment mandates, which have that additional test and that mandate to go further than just good financial integration.
Yeah, the issue of scale needs.
Yeah, it's just not big. And I don't believe any of you see all the figures about, there's 50 million trillion in ESG managed funds. That's nonsense. That means that's just adding up everyone who's signed PRI. But there's lots of firms have signed PRI and are doing almost nothing, honestly. So what really matters, are they in a kind of legally mandated responsible investment or sustainability or impact fund with a mandate to go further?
Well, I think that's an issue that is increasingly the subject of attention and scrutiny, and will only continue to be so. And I think there are now efforts to try and put some standardisation and order to the market out there. So listen, Andrew, you said that it was a field that was very much niche and not mainstream before. It never used to attract the bright and the best. That's clearly not the case anymore, I'm happy to say. You're off the hook for a little while, but you're not off the hook completely. But thank you. Join me in thanking Andrew.